Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 3. This is Section C. This is an application topic. Determine the amount and timing of revenue to be recognized using the 5-step model and prepare journal entries. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. What are you going to be doing on test day? You're going to be answering multiple choice questions and sims. So instead of watching hours of lectures and reading through big textbooks, the biggest thing you should be doing is practicing questions to learn the material. And if you want to learn more about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. Again, it's only 1 hour, it is free, and we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time. And after you watch that, you're going to want to learn more, so make sure you check out becoming a SuperfastCPA Pro member, because Pro members get access to not only the Pro course, where Nate goes over step by step in a very detailed way exactly how you should be studying, but also they get access to the full 10-question versions of these videos that I make on YouTube. We're only going to be going over 5 questions today, but again, SuperfastCPA Pro members get access to the full 10-question video, so they get a little bit more practice and a little bit more understanding. So again, make sure you check out the webinar, and make sure you check out becoming a Pro member. And with all that, let's dive straight into the questions. All right, here we are at question 1. As we dive into this question, one thing we always like to point out is you should read the last part of the question first. This is a really good habit to be in, especially on test day, because you have no idea what you're going to be seeing. So you should read the last part of the question first to give yourself context for what you're about to be dealing with. So again, let's read the last part of the question and then let's go up to the top. When should Smart Tech Co. recognize revenue from this transaction? So let's go up to the top. On January 1st, 20X1, Smart Tech Co. signed a contract with Build It Corp. To manufacture and deliver a custom piece of machinery. The contract price was $120,000, and payment was due 30 days after delivery. The machinery was completed on March 1st of 20X1. The machinery was delivered to Build It Corp. On March 15th, 20X1, and Build It Corp. Made the payment on April 14th, 20X1. So we have all the dates, we have the amounts. Again, there's not too much going on here, but when do they actually recognize the revenue from this transaction? Now, if you have no idea how this works, that's okay. We're going to be using this question to figure out how it works. If you've seen this before though, which you probably have, you probably already know the answer. These questions aren't extremely complicated, but it's again to show you the different nuances and different types of questions that you're going to be seeing when it comes to revenue recognition. So if you don't already know the answer, go ahead and pause the video if you want, and when you're ready, come back, we will look at the answer together. Okay, here we are. The answer is C. March 15th is when they're going to recognize the revenue for that machinery. So let's go through this. We're going to talk about the 5-step recognition model. This isn't something you're going to see what is the first step in the revenue recognition model. What's the third step? I don't think that you're going to be seeing something like that. You just generally need to know how this works. So we're going to walk through this once, but then the rest of the video, we're not going to really reference the whole 5-step model. We're just going to talk about, how you recognize revenue, but it is based off of this model. So let's walk through it. Under the 5-step revenue recognition model, revenue is recognized when the performance obligation is satisfied. Let's go through the steps. First, identify the contract. That's the first step. The contract was signed on January 1st, 20X1. It says there was a signed contract, so there's the contract right there. Step 2, identify the performance obligations. Smart Tech Co.'s performance obligation is to manufacture and deliver the custom machinery. So again, there has to be obligations. Somebody has to do something and somebody has to pay them, or maybe somebody has to do something and then the other person has to do something in return. There has to be something that is happening. Step 3, determine the transaction price. So if there is a price, the price would be $120,000 in this case. Step 4, allocate the transaction price to the performance obligations. Now, we're not going to really dive too much into that in this video. Just know that based on information, you're going to have to sometimes allocate different amounts to different performance obligations depending on the scenario. Step 5, recognize revenue as the performance obligation is satisfied. The performance obligation is satisfied upon delivery of the machinery to Build It Corp. On March 15th, 20X1. So that is the most important part right there. They recognize the revenue when they deliver the machinery. Let's walk through this last part. Revenue is not recognized on January 1st because no performance obligation was satisfied at that time. That's the date that the contract was created, but that's it. That's the only thing that happened when the contract was created. Similarly, revenue is not recognized on March 1st, 20X1, as merely completing the machinery does not transfer control to the customer. Revenue is also not recognized on April 14th, as payment timing does not typically determine revenue recognition under GAAP. So basically, what we learned in this question is when there is a specific point in time when the performance obligation is to be completed, once it's completed, that's when you recognize the revenue. So even though they finished making the machinery on one date and they got paid on another date, the date that they're going to recognize revenue is the date that they deliver the finished product to the customer. The date that your performance obligation is totally finished, that's when you can recognize revenue in this case. We are going to talk about revenue recognized over time as well in this video, but when there's a specific point in time, you recognize revenue on the date that the performance obligation is completed. Not before, when you might finish a part of it, or not after, when you actually get paid. It's when you complete the performance obligation. Now let's go to the next question. Okay, here we are at question 2. What is the gross profit recognized in 20X2? Let's go up to the top. On January 1st, 20X1, Prime Build Co. signed a $4 million contract to construct a commercial building for a client. The project is expected to take 3 years. Prime Build Co. uses the percentage of completion method to recognize revenue. The following data is available for 20X1 and 20X2. Gross profit recognized in 20X1, $200,000. Actual costs incurred 20X1 is $1,200,000. Actual costs incurred in 20X2, $1,400,000. And then the estimated costs to complete this project at the end of 20X2, so they're estimating at the end of 20X2, we're still going to have another $800,000 of costs to finish this. So with all that information, we have to figure out what the gross profit is that is going to be recognized in 20X2. So if you've never dealt with the percentage of completion method, then you might not really know how this works. It's not too difficult once you know the steps. If you know how to do this, or if you have an idea, pause the video and come back when you're ready. If you have no idea how to do this, that's okay. We are going to use this question to learn how to do it, because again, what are we doing? We are using the questions to inform us what we need to know. We're using the questions to learn the material. Now let's go to the answer. All right, here we are. The answer is A, $258,824 is the amount of revenue or gross profit that's going to be recognized in 20X2. So let's go through this. Again, there are multiple steps, but they're not too bad once you know how it works. To calculate gross profit recognized for 20X2, we follow these steps. First, you take the actual costs incurred to date as of the end of 20X2, which in this case would have been the $1,200,000 from 20X1 and the $1,400,000 from 20X2. So those were the actual costs that we for sure know as of the end of 20X2. So that's $2,600,000. We also add the remaining estimated cost to complete the project as of the end of 20X2. So again, remember, at the end of 20X2, they are guessing or estimating that they still have another $800,000 of costs to be able to complete the project the next year. So we add that estimated amount plus the actual amount, and that gives us the total estimated cost of the whole project, and that's $2,600,000 plus $800,000, giving us $3,400,000. Now that we know that, we can then figure out the gross profit percentage. First, we have to figure out what the gross profit is, though. The expected gross profit for the entire project is the contract price minus the total estimated costs, or $4 million, that was the contract price, less the $3,400,000 of estimated costs that we just calculated. So they are expecting to have $600,000 of gross profit throughout the whole project. Now that we know the expected gross profit for the whole project, we can figure out how much of that gross profit is being recognized in 20X2. The percentage of completion as of 20X2 is the actual costs. So this $2,600,000 of actual costs. So these are the costs that they have already incurred. They know we already spent this money. You divide it by the total estimated cost. So $2,600,000 out of $3,400,000. That means that according to the costs, the project is 76.47% complete. Since we are 76.47% complete, we can only recognize 76.47% of the gross profit that we're expecting to get, at least at the end of 20X2. So we apply that percentage, 76.47%, by the full $600,000 of expected gross profit, and that gives us $458,824. Again, that is the amount of gross profit they are expecting to have had by the end of year 2, not by the end of the project, by the end of year 2 or 20X2. But there's one last thing that we have to take into account. We have to subtract the gross profit that was already recognized in 20X1, which was $200,000. That was given to us up at the top. So we subtract $200,000 from $458,824, and that gives us $258,824 of gross profit that is recognized in 20X2. So again, it's not too difficult once you understand how it works. If you missed anything in that, go ahead and pause the video, kind of look at that answer a little bit more. And once you understand that, let's go to the next question. Okay, here we are at question 3. What is the total revenue or loss Build Strong Co. must recognize for 20X3? On January 1st, 20X3, Build Strong Co. signed a $5 million contract to construct an office complex for Skyrise Inc. The project is expected to take 3 years, finishing in 20X5. Build Strong Co. uses the percentage of completion method to recognize revenue. The following data is available for 20X3. The actual costs incurred in 20X3 were $2,800,000. The estimated costs to complete as of the end of that year is $2,600,000. So with all that information and what we just learned from the previous question, what do you think the total revenue or loss is going to be for the 20X3 year for Build Strong Co.? Pause the video. Again, apply what you just learned in the previous question and come back when you're ready. We will talk about it. All right, here we are. The answer is A. They would have a $400,000 loss. So in this question, we are learning how losses are treated when it comes to the percentage completion method. So let's walk through this. First, we have to, again, determine the total estimated costs. And just like we did in question 2, you take the actual costs that were incurred in 20X3, and then you add the estimated costs that there are to complete it. So that's $2,800,000 plus $2,600,000, giving you $5,400,000. Now we compare that to the contract price. The contract price was $5 million. So that's the amount that they are expecting to get from this contract. But they are also estimating right now that they're going to be spending $5,400,000 to finish the project. So they're going to have a $400,000 loss. Now, unlike when there was revenue, where we calculate the percentage of the revenue that can be recognized in that year based on the percentage of the project that's completed, we recognize the full $400,000 loss. Under the percentage of completion method, losses are recognized in full immediately when total estimated costs exceed the contract price. Since this is the first year of construction and no prior benefit has been recognized, the total loss of $400,000 is recognized entirely in 20X3. So if you ever see a situation where you are looking at a percentage of completion and you are realizing that they had a loss, you don't apply the percentage of completion to the loss. You just realize, oh, we're going to have a loss. Then we recognize the full loss. And remember, again, in accounting, when it comes to income or losses, we are way more likely to recognize a loss quickly because, again, accounting is conservative. So that is how it works when there is a loss with the percentage of completion method. Now let's go to the next question. All right, here we are at question 4. How much revenue should Harbor Travel Agency recognize for this transaction? On September 15th, Harbor Travel Agency arranged a vacation package for a client, including flights, hotel accommodations, and car rentals. The total cost of the package to the client was $10,000. Harbor Travel Agency negotiated these services with suppliers on behalf of the client and received a 12% commission from the suppliers for its services. So with all that information, what is the revenue that Harbor Travel Agency is going to recognize from all of this? Pause the video, come back when you're ready, think through this, and when you're ready, come back, we'll look at it together and kind of understand another part of revenue recognition. All right, the answer is A. They would only recognize $1,200 of commissions. So let's walk through this. This is a different part of revenue recognition than we've talked about so far. This is an agent-principal relationship. We're not going to dive super into that for FAR. That is something that has been mainly moved to BAR. So this is just a very light overview, a light dive into this. An agent recognizes revenue for the amount of commission it earns for arranging or enabling transactions on behalf of a principal, not the gross amount collected from the customer. So their commission is just the $10,000 multiplied by the 12%. That gives you $1,200. Harbor Travel Agency, acting as an agent, should recognize $1,200 as revenue, reflecting the commission earned for facilitating the transaction. So again, because Harbor Travel Agency is the agent in this situation, they are acting on behalf or performing a service for the suppliers, so that the suppliers can help the client. Harbor Travel Agency is just getting a commission. They aren't getting the $10,000 because that is going to the suppliers, because the suppliers are the ones who are actually going to provide the services. They're going to provide the flights. They're going to provide the hotel accommodations, the car rentals. But Harbor Travel Agency helped the clients to get connected to the suppliers, so the suppliers are paying them a little bit of money out of the total profit for the suppliers. So again, this is not something you're going to dive super into, agents and principles in the FAR exam. Way more important on the BAR exam. But if you ever see a question like this where somebody is doing something on behalf of somebody else and they're receiving a commission for it, they're just receiving the commission as revenue. They're not recognizing the rest of the money because the rest of the money goes to the principal or the person who's actually taking on the risk, who's actually performing the services for the people who the agent is helping. All right, now let's go to the next question. All right, here we are at question 5. What is the appropriate journal entry to record the receipt of the upfront payments? On April 1st, Summit Financial Services collected upfront fees from its 40 existing clients for advisory services to be performed throughout the fiscal year, which runs from April 1st to March 31st. Each client pays an annual fee of $12,000 and services are provided evenly throughout the year. Summit is not accepting any new clients. So again, with all that information, what is the appropriate journal entry to record the receipt of this upfront payment? So if you have any idea how this works, or if you have any idea from the questions that we have just done, go ahead and pause the video and try to figure this out. If not, that's okay. We're going to look at the answer together. All right, here we are. The answer is B. You would debit cash for $480,000. That's the easy part. You would credit unearned revenue for $480,000. So if you got any of the other answers, let's walk through this. When fees are received upfront for services to be performed throughout the fiscal year, the full amount is recorded as a liability, which would be unearned revenue at the time of the receipt. Revenue is then recognized evenly over the fiscal year as services are provided. Before we talk about the journal entries, remember, when you receive money for something you haven't actually performed the service for, you're just receiving the money up front and you still have the responsibility to actually perform the service that came along with receiving that money, it's unearned revenue. It's not actual revenue because you haven't actually performed the service to receive that money, to receive that revenue. So again, the first entry is going to be you debit cash $480,000, you credit unearned revenue of $480,000. So this is a liability sitting there on your books. This entry reflects the obligation to provide services over the next 12 months. Each month, $40,000, which is $480,000 divided by the 12 months, will be recognized as revenue as services are performed. And what would that look like each month? It would be a debit to unearned revenue and a credit to service revenue. So they would actually be recognizing real service revenue each month for $40,000 and getting rid of that unearned revenue liability as they do it each month. So again, this is just another aspect of revenue recognition. We went over a lot of different things in these 5 questions. Before we go any further, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions, you will notice the things that keep popping up. You've seen 2, 3, 4 questions trying to teach you how revenue recognition works for a construction project. You know, those percentage of completion questions that we were talking about, or something else. Again, these are the things that you see, that you notice are important throughout the questions that you're doing. So you take a moment, you write down these pillar topics in your own words, kind of summarizing the most important things you learned from the questions you did that day. And as you're doing this each day, you are building your own personal repository in your own words and your own knowledge of the most important things you need to know for exam day based on the questions that you went over. So let's go ahead and dive into the pillar topics for this video. Okay, here we are at the pillar topics. Again, remember, this is kind of a summary of the things that we learned. Now, your pillar topics might be slightly different from mine, but again, these are the things that you see throughout the questions, so it shouldn't be too much different if you are paying attention to what you're learning in the questions. So let's walk through this. First, revenue recognition timing. This is a big thing that we are, of course, that's kind of like the whole idea behind all of this, but there's different parts of it. Revenue is recognized when a performance obligation is satisfied, which is when control of a good or service is transferred to the customer. Payment timing or contract signing does not determine revenue recognition. So remember, when you get the money or when you start a contract or whatever the case may be, that is not when you recognize revenue. You recognize revenue when you have completed your part of the contract, whether that's all at once, you just deliver the good and that's it, you recognize revenue right there, or if you are giving service over multiple months, you're recognizing revenue each month as you do this. Again, recognizing revenue is not when you receive the money, it's not when you start a contract, it's when you perform what you're supposed to perform. Now let's talk about the percentage of completion method. This is, a part of revenue recognition. The percentage of completion method calculates revenue or profit based on the actual costs incurred to date as a percentage of total estimated costs for the project. So based on the costs that you're expecting to pay for the whole thing, compare that to the amount of costs you've actually incurred throughout. You're going to use that percentage to then apply it to the gross profit you're expecting to receive, and that will tell you how much gross profit you are recognizing in a given year. Now, when it comes to recognizing losses, for long-term contracts, any projected losses are recognized immediately, regardless of the project's completion percentage, ensuring accurate financial reporting of expected outcomes. So remember, you're not applying the percentage of completion percentage to a loss. If you realize there's going to be a loss, you just recognize that loss in the year. It's kind of brutal, but again, that's how accounting is a lot of the time. It's conservative. It wants to recognize losses quickly and only recognize revenue when it is certain, like you for sure have gotten that money or you for sure are going to get that money. Now let's talk about the agent versus principal revenue recognition. Again, agent versus principal, this is something that you're not going to dive into very much for FAR. This is something that's been moved mainly to BAR and, a little bit on reg as well. But overall, what you need to know for FAR is that an agent, which is, again, somebody that's acting on behalf of somebody else, an agent recognizes only the commission or fees earned for facilitating a transaction. They don't recognize the total gross transaction amount handled on behalf of the principal because, again, the principal is the one who is actually, providing the product or providing the service. The agent in these cases is just the person who is kind of facilitating, hey, here's a customer, I'm going to send them to this principal or whatever the case may be. They are only going to earn their commissions or fees as revenue. They're not going to recognize the full amount that is actually going to the principal. And finally, with upfront payments and unearned revenue, when fees are collected upfront for services provided over time, the amount is recorded as a liability, and that would be unearned revenue. Revenue is then recognized systematically over the period as the services are performed. So again, you can recognize revenue at a certain point in time, which is when you just complete your obligation. You gave them the equipment that you were supposed to make for them. That's when you recognize revenue. Or if it's a service obligation and you're going to be giving them service over multiple months, you will recognize the revenue as time goes on instead of all at once. And again, if you receive money up front, you're going to record unearned revenue because you haven't actually completed the service obligation yet. And with all that, we've gone through a lot in this video. And again, we've only gone over 5 questions. Remember that SuperfastCPA Pro members get access to the 10-question video where I'm about to go over another 5 questions with them once I finish this part of the video. So if you like this and you like our other videos, make sure you check out becoming a SuperfastCPA Pro member. And the easiest way to kind of get introduced to SuperfastCPA and the Pro course is to go to our SuperfastCPA training webinar on SuperfastCPA.com. You can sign up for that. It's only 1 hour and it's free. And if you watch that, you will learn a lot about how to pass the CPA exam, again, for free. And then you're probably going to want to learn more. So again, check out the Pro course. I hope this was all helpful. If you liked the video, make sure to like it and leave a comment. And with all that, I will see you in the next video.